All right, welcome back to The Explainer. Let's just dive right in, shall we? Because today we are setting the stage for an absolute masterclass on underwriting commercial real estate deals. If you've ever looked at a pro forma and thought, these numbers look a little too perfect, well, you are in exactly the right place. We are going to learn exactly how to spot the hidden traps that trip up even the most seasoned investors.
But first, we need to shatter a massive illusion right out of the gate. An offering memorandum, or OM, it is not some objective financial disclosure. It's really just a sales brochure. It is highly crafted by a broker whose overriding goal is to get the absolute highest possible price for the seller. So from this moment on, I want you to consider yourself a financial detective. Your job is to strip away that broker story and dig for the actual truth.
So here's how we are going to systematically dismantle an OM today. We've got the broker's illusion, busting common broker myths, bridging the truth gap, the red flag audit, and finally, the golden rule.
Okay, let's start with Section 1, the broker's illusion, and stripping away the story. Winning commercial real estate investors all share this one absolutely crucial mindset. They treat the OM purely as a launching pad for investigation, never as a source of truth. Why? Because if you just take it at face value, you are risking a massive cascade of failures. We're talking wasted time, bleeding money on legal fees, and, worst of all, risking your hard-earned earnest capital on a deal that is just structurally flawed from day one.
Moving right along to Section 2, busting common broker myths and the financial levers they use.
Let's look at the very first lever brokers love to pull: completely unrealistic expense ratios. The myth you'll see plastered across OMs for older Class B or Class C properties is this magically efficient 30 to 35% expense ratio. Sounds great, right? But the cold hard reality, older properties typically run at a 45 to 55% expense ratio once you actually factor in proper management, real-world maintenance, and realistic insurance.
So you might be wondering, how on earth do brokers get that number down to 30%? Well, they hide the costs. They'll assume you're going to manage the property yourself for free, or they'll drastically understate the insurance premiums. Or, and this is honestly my personal favorite, they take everyday recurring repairs like, say, fixing a leaky toilet, and creatively reclassify them as capital expenditures just to completely scrub them from the operating expenses. It's wild.
Now, the second financial lever is aggressive exit cap rate compression. The pro forma will aggressively project that you'll buy at a 5.5% cap rate and then magically sell at a 5.0% cap rate in year 5. Basically, they're saying the market will suddenly be willing to pay more for the exact same income stream. Banking on that, especially in a changing rate environment, is pure speculation. The fix here? Build yourself a safety buffer. Always underwrite your exit cap rate at least 25 to 50 basis points higher than your entry cap rate.
The third lever is inflated market growth assumptions. The broker myth projects rent growth at an amazing 5 to 7% annually for your entire 5-year hold. But let's be real. Double-digit or even high single-digit rent growth is rarely sustainable long-term. To really protect yourself, model conservative rent growth instead, typically 2 to 3%, basically tied to historic inflation. And honestly, take it one step further. Cross-reference the local municipal planning board for upcoming permits. You need to know if new supply is about to flood your market and kill those growth numbers.
All right, Section 3, bridging the truth gap, T12 versus pro forma. I'm going to let you in on a secret. The most treacherous page in the entire OEM is the side-by-side comparison of the trailing 12 months historicals versus the year 1 pro forma. Just look at how the tricks are played here. The OEM cleverly keeps property taxes at the current owner's historic rate, but reality dictates taxes will almost always reset based on your new higher purchase price. For insurance, they'll just use last year's rates, completely ignoring that premiums are rising rapidly nationwide. And repairs? Kept unusually low to artificially inflate the net operating income. It's basically a trap.
Oh, and one specific line item here is absolutely critical: bad debt. Brokers will often just completely erase bad debt in year 1, assuming your quote-unquote improved management is going to magically cure all ills. Guys, that is a massive red flag. Historical bad debt reflects the physical location and the actual tenant base you are inheriting. That kind of thing rarely vanishes overnight.
Section 4, the Red Flag Audit, a 4-step sanity check. So here is your actionable playbook. This is the 4-step sanity check that every winning investor runs to protect their capital. We calculate the expense ratio, verify the tax reset, normalize fees, and compare rents. Let's break these down.
Step 1 is just simple math, and it's your very first line of defense. Divide total operating expenses by the effective gross income. If that number comes in below 45% on an older asset, the baseline is definitely understated. Stop right there and go digging for those hidden costs we talked about earlier.
Step 2. Verify the property tax reset. Just bypass the OMM's historic tax rate entirely. Ignore it. Multiply your estimated purchase price by the local millage rate, which, by the way, is just your local property tax rate, and the assessment ratio. This simple calculation gives you the real post-acquisition taxes you will actually owe.
Step 3. Normalize management fees. You absolutely must price in a market rate management fee, which is typically 3 to 5%, even if the current owner swears up and down that they self-manage for free. Look, your time has value. Plus, any future buyer is going to underwrite for professional management anyway, so you have to price it in today. Step 4. Compare rents. The OM will practically always claim that current rents are, let's say, $300 below market, heavily implying this massive upside for you. Never blindly believe this, ever. Demand concrete proof via verified comparables within a strict 1-mile radius. Do not take the brochure's word for it. Make the actual data prove it to you.
Which brings us to Section 5, the Golden Rule, and the final verdict.
Everything we've talked about today really comes down to this one golden rule of underwriting. Never pay today for the value you intend to create tomorrow. You must buy the asset based on its actual, historical, trailing 12 performance. The broker's pro forma strictly represents your potential upside. It does not represent your purchase price. Think about it. If you pay for the pro forma on day one, you are taking 100% of the risk with absolutely zero margin for error.
So, that leaves us with one final provocative question for your very next deal. Will you fall for the broker story, or will you use these tools to uncover the truth? Because you now have the mindset of a financial detective and the exact audit needed to dismantle any OM. Apply this, critically interrogate those numbers, and protect your capital. Thanks so much for joining me on this explainer, and hey, happy investigating.